Hersh Shefrin, Beyond Greed and Fear, Understanding Behavioral Finance and the Psychology of Investing. Dive into the fascinating world of behavioral finance and the psychology of investing with Hersh Shefrin's insightful book, Beyond Greed and Fear. This summary explores the notion that financial markets are not always efficient, as traditional financial theory would have you believe. Here, emotions like fear, hope, greed, and regret play a significant role in influencing investors' decisions, leading to both costly mistakes and lucrative opportunities. The summary delves into three primary themes of behavioral finance: heuristic-driven bias, frame dependence, and inefficient markets, and provides real-life examples of how these concepts affect investment decisions. By understanding these behavioral patterns, readers can learn how to avoid common pitfalls and make smarter financial choices.
Revisiting the myth of rational markets. Financial markets are not as efficient as believed. While traditional finance theory suggests that stocks are priced according to their true value due to the vast amounts of information available and the number of buyers and sellers in the market, the new school of behavioral finance challenges this theory. It suggests that investors are prone to emotions, leading even experts to make poor investment decisions based on faulty logic and unrealistic expectations. Behavioral finance teaches investors to recognize these patterns and avoid them, rather than trying to beat the market. Contrarian investors like David Dreaman and Peter Lynch, who invest in stocks with low price-to-earnings ratios and what they know, respectively, have been successful precisely because markets are not always efficient. Understanding this can help investors make better decisions and avoid costly mistakes. The complexities of behavioral finance. The traditional belief that greed and fear drive investors is misplaced. Instead, hope and fear are the primary emotions that influence investment decisions. Behavioral finance delves further into this concept by examining how heuristic-driven biases, frame dependence, and inefficient markets interplay. Heuristics, or mental shortcuts, often lead investors to erroneous conclusions, while frame dependence influences how investors perceive risks and rewards. Ultimately, investors' imperfect decision-making processes lead to market imperfections. By understanding these emotional and cognitive factors, investors can make more informed decisions and navigate the complex world of finance. Pitfalls of behavioral finance. Behavioral finance principles, such as short-sightedness, overconfidence, and lack of self-control, require common sense and moralism. Americans fail to make sound retirement decisions due to loss aversion, risk aversion, and self-control issues. Denying disconfirming evidence and focusing only on confirming evidence leads to investors' poor returns. The problem extends to individual investors who suffer from trading too often and denial. To make the right investment choices or retirement plans, people must consider all evidence, save instead of consume, and control emotions while assessing risk. Behavioral finance, though complex, needs practical and ethical application. The costly mistake of Get-Evenitis. Get-Evenitis is a common mistake made by both novice and professional investors. The tendency to hold on to losing investments in hopes of a rebound often leads to devastating consequences. Examples include infamous trader Nick Leeson, who caused the collapse of a 232-year-old company, and corporate executives who refuse to pull the plug on money-losing projects. Individual investors are also at risk, as demonstrated by Melvin Clare, who held on to a losing mutual fund for decades. The Lake Wobegon syndrome, or overconfidence in one's abilities, further exacerbates this issue. The most successful investors know when to ditch their losers quickly, but for others, selling a loss requires accepting a poor decision and taking action to mitigate it. Avoiding investment pitfalls. Many investors fall into the trap of blindly following expert advice, leading to the blame game when things go wrong. The bankruptcy of Orange County due to the misguided bet of its treasurer, Robert Citron, illustrates this. Investors should also be aware of the gambler's fallacy and the dangers of using useless information to make decisions. These common behavioral finance pitfalls lead to sentiment-based risk and errors. Investing is often viewed as a rational, analytical decision-making process. However, many investors make the mistake of blindly following expert advice, leading to what is commonly known as the blame game. If an expert's pick works out and leads to a profitable investment, the investor takes all the credit for a wise and skillful investment strategy. However, if the advice leads to losses, the investor points the finger of blame at the advisor. This blame-shifting behavior was exemplified in the bankruptcy of Orange County, California, in 1994, where Treasurer Robert Citron relied on the advice of a Merrill Lynch strategist, Charles Clough, to make investment decisions. When those investments went bad, Citron shifted the blame onto the strategist. Investors should also be aware of the gambler's fallacy, a mistake that often leads to investors making decisions based on too few facts. Citron forecast a recession in 1988 because the economy's expansion was longer than average, but the recession didn't arrive for 2 more years. This sort of reasoning is similar to that of the gambler who bets on tails after seeing 5 heads in a row. Technical indicators, such as the bullish sentiment index, also feed the gambler's fallacy. Investors wager on trends reversing or continuing based on stereotypes, leading to sentiment-based risk and errors. Many investors only hear half the message about behavioral finance, focusing on abnormal profit opportunities while missing the warning to avoid sentiment-based risk. Investors commit hindsight bias by retroactively changing the reasoning that led to their decisions, a common mistake. This summary highlights the common behavioral finance pitfalls that lead to inaccurate decisions and provides insight into how to avoid these investment traps. Market inefficiency unveiled. Closed-end funds' peculiarities demonstrate market inefficiency in the face of efficient market theorists' arguments. Closed-end funds' unique characteristics challenge the notion of market efficiency as it pertains to open-ended mutual funds, which they differ from because of their fixed number of shares. Such funds are assessed by their net asset value, the market value of the stocks in the fund. Efficient market theorists argue that their prices accurately reflect the market's set prices. However, the following characteristics demonstrate the contrary. 1. These funds are typically priced at 10% above their net asset value. 2. 6 months after their launch, the fund's price typically declines 10% below their net asset value. 3. The magnitude of the discount or premium shifts over time. 4. When a fund converts to an open-ended fund, the discount disappears. The characteristics above demonstrate the existence of extrapolation bias, the practice of betting on trends such as the wild price swings experienced by country-based closed-end funds like the Germany Fund. This fund's shares spiked when the Berlin Wall fell, only to plummet shortly after. The fund's sentiment and extrapolation bias significantly affect prices, as evident in the case of closed-end funds specializing in countries discussed in articles in the New York Times.
In Beyond Greed and Fear, Hersh Shefrin offers valuable insights into the world of behavioral finance and the emotional forces that drive investors' decisions. This summary highlighted that emotions such as fear, hope, greed, and regret impact financial decision-making processes, leading to both lucrative gains and catastrophic losses. The 3 themes of heuristic-driven bias, frame dependence, and inefficient markets provide a framework to identify how these emotions translate to the investment choices that people make. Having gained this understanding, readers can learn to recognize and avoid the mistakes that lead to emotional investing while developing a more strategic and disciplined approach to managing their wealth. This knowledge allows them to become better investors, even if they can't entirely escape the emotional undercurrents tied to investing.